Good evening, good evening. How you doing, Tom and Jesse? And welcome everyone who is joining us for this webinar, which has been a series of sessions that's been focused on informing individuals as much as we can. Now, as the title suggests, we want to help you to navigate your journey. And if you are like me, then in most cases, when you are traveling around, you may use Waze or one of the various other apps to navigate the city of Toronto. And although we've got these tools, it sometimes seems to feel that the journey is still challenging, whether it's going to be congestion, accidents, pitfalls, or just various impediments that get thrown into the mix. That's kind of the case also with the real estate market, interest rate markets, and just life in this day and age. So it takes more skill, more strategy, and more collaboration to just get ahead or where you want to go. And that's why we're here today, to put our heads together and to have an open conversation and share information and insights on these topical matters. This is our agenda for tonight. We're going to have a bit of a poll just to kind of gauge and to get a sense of where each person's at, what are some of the key things you want to learn from the conversation today. And then I'll hand it off to our panelists. We've got Tom and Jesse. And I'll be also presenting a segment as well. It's been a while since I presented, so I'm looking forward to that. And then we'll lead into a Q&A, which is usually where a lot of learning takes place. So if you are joining for the first time, my name is Orlando Lopez, and I'm an investment advisor and a financial planner here at RBC Dominion Securities. It's been going on 4 years since I've been with RBC. I've been in the industry for over 13 years. And I've been not only sharing my knowledge with clients over these years, but also in another capacity, I taught finance at York University. So a lot of what I do and a lot of what I enjoy is just learning and then sharing and strategizing. And then that's what we'll do. Outside of that, busy with a young family, daughter, a son, and a wife. So I'm always doing this, that, and the other. And but try to make sure that I have fun while I'm doing it. So this maze, when I came across it, it just sort of, it sort of resonated because I think as things stand right now for young people entering the housing market in Canada, it can feel like trying to get to the other end of this maze. And we hope that by the end of the call, by this webinar, that you'll feel like you've gotten a little bit closer to the exit than before you are joined. So first things first, I'm going to ask everyone to just pull out your cell phone, and you can take a snapshot of this QR code. So you should be seeing it on my screen right now. Let me just pull it up. Okay, there we go. So you can go to finder.com, or you can go take a picture of that QR code and it will bring you to the first question. All right, so let's kick that one off. So first things first, which of the following currently applies to you? Are you currently renting? Do you own one property, 2 or more properties, or do you own one property such as your principal residence? We'll give people a little bit of time. All right. And so predominantly, we've got 60% that are renting and may be exploring their options as it relates to getting into the market. Next question is, if you were to buy a property in the future, what would be the purpose? Would it be for as a principal residence, investment property, or recreational / lifestyle, for example, a cottage? Very interesting. Tom and Jesse, do you see that? I thought it would be predominantly, and again, that's why I don't try not to make too many assumptions, right?
No cottage. Surprising.
Yeah. And at one point, the investment property was actually leaded, right? Okay, so 55% principal residence, and then, oh, look at that now. Okay, now we've got a tie. Next question. And who are you hoping to help with the information that you're going to gain today? Is it for yourself? Is it for a family member, such as, children or grandchildren, or for a friend, or combination? Okay. So predominantly something that for yourself to use to execute on. Okay, wonderful. And which of the following segments is really important for you in this conversation that you really want to kind of dive into and get as much as you can from that? We've got the FHSA, real estate market, interest rates. Okay, this one was swinging back. Oh, this one was swinging back and forth. At one point, FHSA was up there. All right. And hopefully, this doesn't put any pressure on any of us. This is just no pressure. All right, and I think that is the last one. Okay, wonderful. So let me pull back up here. Perfect. Right. So without further ado, I'm going to pass it on to Tom, who's going to kick it off in terms of just where things are at with the real estate market. Feel free, give a bit of an intro on your practice, and then definitely share what's going on with the market, and then Jesse will take it on from there in terms of the interest rates that would apply to any financing that one would get to sort of navigate the market. And then I'll come on the tail end with the FHSA information. So wait, let me just see here. I'm going to hand it over to Tom. But I don't know if we lost Tom. I have to get you to jump in. Then Jesse, give me one quick sec.
Sure, no problem.
Yeah. Okay. Tell you what, let us probably kick it off with interest rates part first, and then I'll try to pull Tom back in. You good with that?
Yeah, no problem. Definitely.
Okay. All right. Oh, there it is.
Thank you. Oh, there we go.
Tom, you good? Okay, you're on mute, and then you've got control, my friend.
Okay, sorry about that. Yeah, I had internet issues at the worst possible time, but I am here, so you guys can hear me okay?
Yes.
Okay, perfect. So I think to start off tonight, what I really wanted to do was just to kind of give everyone an overview of what is actually happening in the market. Because I think if you turn on the news or read a headline every evening, you hear that either the real estate market is crashing or it is going extremely high. And it's like there's all these differences that we're hearing. So I'm going to try to do my best tonight to make sense of this for you and really break it down. And when I give presentations, nothing that I'm going to tell you tonight is going to be based on like a theory or maybe this could happen. We're going to look at the actual data and do our best to make sense of what is happening. So what I'm going to do in a second here is just share my screen. And what we're going to do is go through the slides one by one and give you kind of a 10 to 15 minute breakdown of what is actually going on. So Orlando, can you see this okay?
Yep.
Okay, perfect. So I'll first start by introducing myself. My name is Tom Story. I've been selling real estate in Toronto for just under 10 years. I run a team in the downtown core, and we do anywhere between 100 to 150 transactions per year. So take this very, very seriously, borderline obsessed with it, and I'm a numbers guy. I make sense of the world based on what is going on the numbers. I frequently talk with CTV News, Global News, and CP24, and I'll go on there on live television and give them updates. So this is kind of like my live update for you, except what's way better about these opportunities is that I have slides that I can go through. So I'm really excited to have the opportunity to share with you what is actually going on. I usually like to start my presentations to give some perspective. Now, what this is a graph from the Toronto Real Estate Board, and this is showing prices back to 1975. So when you hear someone say, well, Toronto real estate prices only go up, that is certainly not the truth. But what tends to happen over the last 40 years is they go up and they go down, but they do so in an upwards direction, if you can see on the graph here. So typically what happens, and this is not like a perfect science, every year it happens like this, but if you go over the last 45 years, we usually have about 3 years of price growth, and then something happens that changes the market, and then we go into a 15 to 18 month period where things are either shifting, changing, and it could be obviously pandemic related, interest rate related, government intervention related. There's lots of different things that could happen, but this is the last 40 years. Now, a few things I want to bring your attention to. You can see the price growth we saw in 1989, and then you can see that prices actually peaked out in 89, and we didn't get back to those prices until 2002. So we have had a significant crash in our market, and it happened from 1989 until 2002. If we fast forward and go to the year 2008, in 2008, with everything that was happening in the United States, the Toronto real estate market actually went up 0.1% that year. However, sales volume was down 50%. Everyone was nervous, but no one was giving away their property. If we continue to fast forward, we get to 2017. You can see that little jump up here in 2017. Our market started in the first 4 months. We went up 26% in 4 months. And at the time, it was the Wynne government in Ontario, and they came in and they said, enough of this. We're putting in rent control. We're putting in a foreign buyer tax and a laundry list of other things that psychologically really cooled off the market. And we thought at the time that those 2017 numbers were going to be very hard to, they might be another 10 years. And then the pandemic happened. And the first 3 months of the pandemic, what we thought was, okay, prices are going to fall off here. People are going to be in a really tough situation. And then it totally changed and went the other direction. So what I want to show you with the graph and really make sense of this is that in the last 45 years, we have had one major market crash. We've had 2 corrections, and then we had last year. And I still think it's too soon to say what we had last year. If you look at the city of Toronto, we were down 14% from peak of the market as March, as February to February, extreme market peak to February this year, we were down 18%. So we certainly did see that change. It's still a matter of time to then look back at what's happening now or happened last year before we understand what we're going to call it. But what this chart will show you is that if you're going to buy real estate, you have to have a long-term plan. If you're going to buy with less than a 5-year plan, I would actually say keep renting because I don't think it's worth it because you don't know when these peaks and valleys are going to happen. This you can take a screenshot of if you want. This is basically just going back to 1977 and showing you the average price, $64,000, and the number of sales that are actually happening. A number I want to bring your attention to is that year 2004, $315,000. That was what it cost to buy a property in Toronto the last time the Leafs won a playoff series. Just wanted to make sure everyone was aware of that. But if we keep going down here, it's the transactions that we have to keep our eye on. So in 2021, we had 121,000 sales happen on the Toronto Real Estate Board. Last year, we had 75,000. There's a 38% drop in transactions. And that's because the buyer confidence was not there. If we fast forward now and we talk about like, okay, that was in the past, but what's happening today? We have now had 3 months where prices in the city of Toronto have actually gone up month after month. And that does actually a little bit surprise me. I thought we were going to kind of stabilize right into the summer here. But on the one side, buyers thought, okay, maybe it's not safe to enter the market because rates continue to go up. But then we had the 2 rate holds in a row from the Bank of Canada. And on the other side, the sellers, just like the buyers, were watching the news and hearing, oh, the market's bad. So the sellers weren't coming to the market. So even though the buyer demand was cut in half, so was the amount of listings. And that's actually what has propped up the market, is that it's the age-old thing that we've always been complaining about, is there is just fundamentally not enough homes to choose from. not just not enough homes to choose from, but the type of homes that people actually want to buy. So if we break down any market, we have three ways to look at the market. We have interest rates, we have immigration, and we have the unemployment rate. I believe these are the three pillars of any market. And then you can add on to this as a bonus pillar, just the inventory levels of what's available on the market. So let's go over each three of these pillars. Now, if two of the three of these pillars are strong, markets are usually balanced out or slowly moving upwards. If all three are strong, we see big increases year over year, 10+%. And if all three are weak, that's when we see a crash like we saw in 1989. If we start with interest rates, today, most people, if they had the variable, are above what they were stressed at, but just slightly above what they are stressed at. So if you got a variable rate in 2018 or any mortgage after 2018, you were stressed up to 5.25%. So I believe that if we stay where we are today and slowly come down as inflation is looking like it's moving in the right direction, we will be okay. But it also depends on how long Bank of Canada holds these rates. We do understand that if inflation gets to 2%, Bank of Canada will bring the interest rate down. It's at 4.5 right now, but their target rate's between 2 and 3 if inflation is under control. So interest rates so far, I'd say we give a half check mark to. We're still not 100% sure, but it's looking okay. Then we have to acknowledge how we got here and why sales numbers were down 38% and why price was down 18% in Toronto. And the reason being is because we saw 8 rate hikes in a row. And then the last two on March 8th and April the 12th, the Bank of Canada did not make any changes. They held the rate. Both of those announcements, immediately after those announcements, we saw an uptick on showings on our listings and our phone ringing with buyers. Because people were then like, okay, I can make a decision now. It's not going to change next month. So this is what is bringing that consumer confidence slowly back to the market. Jesse's going to get into this more with you, but I just want to quickly touch on the type of rates. And this will sound obvious to a few people, but I learned this from when the interest rates are going up, and I want to share my experience with you. Now, the variable rate is directly correlated to what Bank of Canada does. So the prime rate, which is 6.70 right now, that's the actual. So the bank rate is what the bank's getting the money at, and then the prime rate minus or plus whatever you're getting it from at the bank is what you're actually getting. That's the rate that you're going to get. Now, basically for variable rates, Bank of Canada goes up, they go down, they go down. They're directly correlated to that. What I didn't know until about 2 years ago is that there are two types of variable rates. There are static variable rates, which mean that even if Bank of Canada goes up or goes down, your payment doesn't actually change, but it just shifts to more to interest, or if they were to go down, more to principal. But your payment is locked in place. Now, we've heard a lot of talk about the trigger rate. Now, the trigger rate is if you're covering all your interest and now you have to up your payment. And that's what the bank is going to force you to actually up your payment. And then there's the adjustable variable rate, which pretty straightforward. Bank of Canada goes up, it goes up, they go down, it goes down automatically. Now, the fixed rate, which I'm sure Jesse, but it seems to be the product that people are going for these days, the 1 to 3 year fixed rate, is based on the 5-year bond yield. It is not directly correlated to what Bank of Canada does. And to my understanding, the fixed rate is actually below the variable rate, maybe only for the third time ever in the history of both rates. It's usually the other way. So we're at an interesting point in time right now with the rates. Quickly to discuss immigration, what we know is that Canada has goals to bring more people into our country than they previously had. And what we know with immigration is that a large chunk of people, when they're immigrating here, are coming to the Greater Toronto area. And they're not way to make around to here. I think very about now. Unemployment is the third pillar of the market. If people are, oh, sorry, can you guys hear me? Okay.
Okay, you're back now. It was cutting out a bit.
Sorry about that. So unemployment is the third pillar of the market, and unemployment right now, we look like we're okay. It seems like the layoffs that we thought were coming have only really happened in the tech sector, and we've actually increased our job growth from what the expectations were, and a lot of people didn't think that was going to happen. This is the year over year comparison, and this is going to show you This is just for March because the April numbers are not out yet. 2023 versus 2022. So the sales volume was down 36%, but just below there, the new listings was also down 44%. So if you're wondering why the market has rebounded faster than we anticipated, it's very simple supply demand metrics. There's just not a lot to choose from, and buyers are now competing with other buyers based on what they're looking for. Now, this is the true difference in affordability, and I think the sticking point with a lot of people is that we're trying to figure out what problem we've solved. Think of Canada; they'll choose recession over inflation every single time. So they raise rates, they will get inflation under control. The entire world country. But what we need, what happens with rates, if you look at what the rates are today, and actually higher than 5%, but just to give you an idea, if a property were to drop 20% in value, even though the rates are higher and the cost was much lower, if you bought the same property today, if you go to the bottom here and see what it would cost on a monthly basis, it actually costs more. Now, I think what a lot of buyers are hoping is that maybe rates will come down and they'll catch it on the back end of their mortgage, right? That over time they will win by buying at a lower purchase price, which is what you always should do. It's better to buy lower purchase price, higher rate with the expectation that potentially rates could go down. But with the big caveat is that we do not know exactly when the rates are going to change, that we'll have to get inflation to 2%. It's probably going to have to stay there for a period of time before the bank does shift the rates. This is the chart I talked about earlier, and this is kind of the most telling chart to me. This is the actual change in population versus housing completions in Canada. And this is why a lot of people like the idea of investing in real estate. I created a real estate So you can see 416 area code and 905 for different asset classes, condos, townhouses, semis, and detached. Right now, in terms of the markets that are moving the fastest, it's the semi-detached market because it's the entry level to freehold property ownership. So that's what the cost actually is. Quickly, just to wrap this up for everyone, is on the rental market side of things. When interest rates went up, so did rental prices because it pushed a lot of first-time home buyers back into the rental market, unfortunately. And then you got into a rental, and you can usually rent something a bit nicer than you can afford to buy. Advice I would give to anyone that's currently renting right now, if your rent is $2,500 a month and the place you want to buy, the total carrying cost would cost you $3,500 a month, that extra $1,000 a month, force that to a high savings account, pay it like you've already owned the place so you can get used to what that payment's going to be when you get to that point. When we look at investor ownership of condos, 41% of all condos in Ontario are owned by investors. We still don't have enough purpose-built rentals. And if you are looking to buy an investment or currently living in a condo, anything built after November 15th, 2018 does not have rent control. Anything built before does. And that's something that I think everyone needs to know. The one-bedroom average rental price in the city right now is about $2,450. And this is for the 416 area code. And the two-bedroom is about $3,000. So affordability hasn't actually changed that much, but there is opportunities right now that are presenting themselves that may not be there when rates start coming down again. And the opportunities right now, if you're looking to upsize, it's good when higher price properties come down percentage-wise more so you can jump up. That not people are cash buyers, but if you were, you would actually get the discount on the changes in price because the rates are not affecting you. And the first-time home buyers are now going to have an opportunity because you're not competing with as many investors, because with the rates today, unless you're going for long-term appreciation, you're not cash flowing with 20% down anymore. In fact, you're probably going to be negative every single month. But that long-term investor mindset is the way that you have to look at it. We have a foreign buyer ban for the next 2 years in Canada. So that we think that's about 5% of the market. So you're not going to have to compete with that. We do have a speculation tax, which means you can't sell a property just to flip it under 12 months of ownership. And we do have a vacant home tax. So make sure you fill out that declaration every single year. That's my presentation for today. My outlook for spring is that it's going to be the first real spring market we've had in about 3 years. But I don't anticipate major swings in either direction. So thank you for having me, and I hope you learned something today.
A lot of good info, Tom. And then rate-wise, because you touched on rates, just so you can kind of go in more detail.
Yeah,
no, absolutely.
So, sorry, Jesse, go for it.
No. All right. Yeah, no, thank you for sure. I definitely was going to touch on rates. I know it's always top of mind. I just wanted to quickly say, Tom and I do quite a few presentations like this, and I'm always super keen to hear what he has to say, because to his point, nothing that he talked about there was opinion. It was all facts. And that's kind of what you want to know if you're looking to buy or if you own a home already and you've got a mortgage. And so, yeah, Tom, thank you for that. It was really great. Always super interested to hear what you have to say. So thank you. I also wanted to thank everybody joining us tonight. My name is Jesse Merson. I'm a senior mortgage specialist with Royal Bank. I've been in the home finance business now for about 20 years. And I am going to chat a little bit tonight about, I'm going to start with some affordability stuff, and then I'm going to get into mortgage rates, which is, something I get asked about multiple times a day. And so I know it's always top of mind. And so what I'm going to do is I'm going to just quickly share a graph here. Let's get that going. So in terms of affordability, this is from RBC Economics' latest affordability index report. We put these out, I think, every quarter. These are actually free reports as well. So if you Google RBC Economics, you have access to all of this stuff. We also have specialized monthly reporting on the housing market. So there's a ton of great information available at your fingertips to take a look at. This particular chart just sort of tracks ownership costs across different types of homes in Canada, and what the ownership costs are represented as a percentage of median household income. And so you can see the light blue line at the bottom is for condos across the country. The yellow is an aggregate, so of all property types. And then you've got the dark blue line at the top, which is your single detached sort of freehold homes across the country. Of course, they're higher priced, so they're going to be, representing or taking up more of the median household income. Here in Toronto, locally, the number is actually, this line, if it were for Toronto, would go up over here to about right here, be about 86%. So affordability, the pandemic didn't create the affordability issue here in Toronto. It just amplified it beyond what the concerns were before. And so our view is that as we start to see rates stabilize, which to Tom's point, the Bank of Canada has paused the last couple of rate announcements, and we started to see home prices pull back a little bit as well. So this is just a function of the market self-adjusting, and we think that it'll still take a few months, and towards the end of the year is when we'll start to see these affordability measures really improve for everybody, which I think will be a great thing overall.
Jesse, if you don't mind, quick question. I'm just thinking, I'm connecting two dots with what Tom mentioned, where the opportunity lies, and then with the affordability chart and the fact that for Toronto, like this is an aggregate, Toronto, Ontario will be sort of higher. And this might be a question you can answer on the tail end, Tom, is does opportunity also exist predominantly outside of Ontario? So just park that. It's just something that, yeah, with everything, I'm curious if that's also part of where the new environment creates that opportunity.
Yeah, no, for sure. There's definitely different, affordability measures across the country. And we actually, do a deep dive into different markets across the country, and that would be part of some of these reports. And so if anybody is looking for that data, shoot us an email, and we're more than happy to get that info to you. because these reports do not only look at the large metropolitan centers across the country, they do take a look at some of the outer regions as well. And so if you're an investor looking for opportunity, these reports could probably help you, navigate and find opportunities. In fact, I had a client the other day based in Toronto looking at New Brunswick, talking about home prices there and the value for money. Meanwhile, the rental market there is quite strong as well. And so they found a great opportunity. So absolutely, outside of Toronto and Vancouver, the two most, expensive cities in the country, you're definitely going to find opportunities across Canada. I don't know if Tom has any specifics that you'd like to add there.
I would just say, like, right now there's a lot of money going into Alberta from Ontario. And the one thing you have to look at is Toronto, Vancouver are basically appreciation growth markets. You're buying that asset to hope that it goes up in value over time, but you're breaking even or losing a bit of money every month on the carrying costs, where these other markets are cash flow markets, where you get a guaranteed cash flow. But the only thing I'd say is if you're going to invest elsewhere, have someone there that can manage it for you, because in real estate investment properties are not passive, no matter what anyone tells you. There's work involved. So you either buy for cash flow or you buy for appreciation. There's very limited markets that offer you both.
Yeah, but you're buying yourself a job really too. Yeah, which is what you're saying. It's not passive. Yeah.
No.
All right. So what I am going to do now, I'm just going to share. Take a look here. Okay, so here we are here. So this is my next sort of graph that I wanted to share with everybody. And what we're looking at here is, this is a chart for the VIX as it relates to bond yields. And so the VIX is a volatility index. And when you start to see these large spikes and these big up and downs, that means things are quite volatile. And so, back in 2007, 2008, we all remember what happened here. This was the financial crisis. Things were extremely volatile. And so you see these huge peaks, and then things started to settle off. A few ups and downs here. During this time frame, in and around here, there was about a 4-year period where the mortgage prime rate only changed about 3 or 4 times. So rate-wise, things were very, very stable. And then, of course, we get to 2018, 2019. Those were banner years for the Toronto real estate market. Not that impacts bond yields, but then, of course, you see this huge spike early 2020. We all remember what happened here, global pandemic. Things sort of settled down a bit once central banks around the world started to lower rates, once governments started to provide some stimulus. And then what we started to see in, just the last, mid-2021 roughly, things started to tick up. Things started to get quite volatile. And what this has resulted in is an inverted yield curve. And what that means is the yield on short-term bonds are now higher than longer-term bonds. And what does that mean, for you as somebody looking to buy or somebody that has a mortgage? Well, bond yields have a direct impact on fixed mortgage rates. And so right now we're in an environment where mortgage rates are kind of the opposite of what we normally experience. And so typically, if you're looking at the 1 through 5 year fixed rates, the 5-year fixed is typically the highest. And then as you get shorter in term, the rates tick down a little bit. And then historically, a variable closed mortgage rate is about 0.75 to 1% lower than a 5-year fixed. And right now, as of today, we're at the complete opposite of that. So the 5-year fixed is actually the lowest mortgage rate that you can get right now. And as you get shorter in term, the rate ticks up a little bit. And then, of course, the variable rate mortgage right now is well over 1%. In fact, it's almost 1.5% higher than a 5-year fixed. We do expect to see some reprieve. The last few months, the inflation data has been quite positive in that it's come down a little bit, and that's good for rates because that means that, at some point when the Bank of Canada, for example, is confident that inflation will continue to go down, we will start to see them lower rates. And that could happen potentially as early as the end of this year and perhaps going into early next year. So So yeah, that's sort of where we're at with mortgage rates. In terms of inflation, though, I think it's important to point out in March, headline inflation was about 4.5%. And I'm just going to switch to another picture here. Can you guys see that? Did I share that properly? So this here basically shows how much mortgage costs, drive inflation. And if you strip out the mortgage interest component of headline inflation as of March 2023, inflation is actually at 3.5%, still well above the 2% target that the Bank of Canada has. But it's kind of ironic that, mortgage interest costs is driving inflation when, it shouldn't be that way, but in and around a way, that's how it's been playing out. And so I think it's important to see that. And so ideally, if we start to see rates coming down, again, that's just going to further have a snowball effect on inflation coming down. So we'll see how that plays out over the next little while. Again, going back to this chart, though, in terms, I have a lot of clients that want to try and, time mortgage rates and buy, what at the right time. And, we're seeing 0.5% swings in bond yields on a weekly basis, sometimes 0.2, 0.3% swings in bond yields on a daily basis. So as a lender, it's very tough. I mean, banks and mortgage providers, they do not adjust mortgage rates on a daily basis. They look for trends. They look for stability. Could you imagine, how complicated or confusing that would be if every day of the week mortgage rates were different? And so if you are looking to buy in the next, spring, summer, or fall, or if you have a mortgage already and it's coming up for renewal soon, be prepared for that volatility. You're going to see a little bit of up and down. I think overall the trend will be down as we go into fall and winter, but do expect some volatility, some up and down. Just alone this year here at RBC and for all the banks, really, we've seen about 8 rate changes up and down. The trend has been down a little bit, but again, it just speaks to the volatility that we're seeing. And so that's something to be aware of. It's crucial that if you are thinking about buying, get that pre-approval done right away, get that rate commitment because it will protect you against rates going up. And of course, that's a nice peace of mind to have. So with all this volatility, with rates being the opposite of the norm, what do you do? We're seeing a lot of money flowing into the shorter term fixed rates right now. So a lot of people buying homes, a lot of people with mortgages up for renewal. The 2 and 3 year fixed rate terms appear to be that sweet spot where you get a good rate, but at the same time, you're not locking in for too long because, I think a lot of people have the mindset that it's, thinking, why would I lock in for 5 years if, potentially in 18, 24 months from now, rates are quite a bit lower. Meanwhile, you still got to ride out your term for another, 2 to 3 years. People are looking for some flexibility to revisit their mortgage terms in a shorter period of time. And so again, on a lot of the quarterly earnings calls across all the banks, a lot of the executives are basically, saying that as well. They're having a lot of their clients choose the shorter term fixed rates. So that's what we're seeing as well. I think the other thing that will become, more interesting as we start to see prime come down a little bit is that, there are products available out there where you don't have to decide or go all fixed or all variable. You can actually split your mortgage borrowings up into multiple segments. And I think once the variable comes down a little bit, it becomes a little bit more attractive and people are confident that rates will continue to go down. We'll start to see more money go into variable. But for some peace of mind, for that just in case component of your mortgage, you can lock in a portion. And so, a lot of my clients will do a 50-50 approach to this, and it's a diversification approach, just as, it's the number one rule in investing, diversify. And I think it's a great strategy when you're borrowing money to buy a home, have some peace of mind, lock in a portion of your mortgage just in case rates go up. But if you do have some confidence that rates are going to go down, historically variable is a better option and you want exposure to that. These are the types of products you should be taking a look at and asking your mortgage professional about. I think they're great products. Again, right now the variable is not that attractive, but I think towards the end of the year, next year, when pricing there improves, it's definitely something worth considering. So, you know, the rate conversation that I'm having lately almost changes on a biweekly basis. Again, just speaking to that volatility that we're seeing. So it's really important to keep in touch with your mortgage professional, have those conversations, and, you know, the best thing they can do for you is just listen to what your needs and wants are. And quite frankly, at the end of the day, you know, you got to go with your gut feeling and choose a term that you're comfortable with. You don't want to be, you know, lying in bed at night worrying about your mortgage rate. So again, yeah, have those thorough conversations, and that will definitely set you up for success. So yeah, I guess Orlando, I'll hand it back over to you.
All right. Thank you. And let me pull up. Okay. So what I'm going to focus on, and this word kind of came up a couple of times from both Jesse and Tom, which is strategy. And whenever I hear the word strategy, you know, the game of chess or games in general come up. So I want to use that concept to then tie in on this new first home savings account. And two different games, checkers versus chess, different rules, different ways in terms of the objective and what's the aim of this particular game. And I want to use that to sort of help people to, one, you know, distinguish between these different vehicles that exist. So if you think about when you're learning, you know, checkers or you're learning chess, the first thing that needs to be understood are the basic rules and how things move before you start to then actually apply strategy, right? So I think that's where we're all at right now with the new first home savings account. It just came out officially this month is when certain institutions are able to open the account. It's so new that not all institutions are able to offer it. It's so new that even within the same institution, not all business units. So everyone is learning. Industry people are learning, consumers are learning, even individuals within the Canada Revenue Agency are learning, because again, it's such a large institution, a large government entity, that there's not one person that sort of creates this or is going to administer it. So basic rules and the objectives of, you know, the game. So checkers, the objective of the game is to take all of your opponent's pieces. That's how you win. While in chess, the objective of the game is to checkmate the king of your opponent. You don't necessarily have to take all their pieces to actually win the game, just by checkmating their king. So then I now kind of bring that home and say, well, let's go back and remind ourselves of what were the objectives of certain other tax vehicles. So the RSP, Retirement Savings Plan, the main objective of that was, you know, created with the intent to encourage Canadians to save to fund their retirement. That was one of the core principles behind it. And then there were certain modifications that sort of said, well, you know, let's also allow for Canadians to, one, tap into this to purchase a home, and they can then put that money back into that nest egg. And that's what is referred to as the home buyer's plan. It allows you to pull out $35,000 from your RSP, use it for purchasing a home. And then there are certain rules around that in terms of, you know, putting that money back into your RSP over a period of time. Another tax shelter that came about was the Registered Education Savings Plan. Objective of that was to help Canadians to finance and to fund the cost of post-secondary education for their children. So that comes with its own special rules and money going in and money coming out, right? You know, how much goes in and how much grant is received and what's required in order to pull money out. So again, different rules on how money is grown. You know, is it taxed while it's in the account? Is it taxed while the money comes out? Won't go into detail with that because that's not what we're here to talk about today. The Registered Disability Savings Plan is another one that exists to finance, essentially, I think the objective was to finance the cost for a disabled individual in their latter years. And now the first home savings account. Purpose is to help Canadians who do not currently own a home to save to buy their first home. And part of that, when you look at, you know, when the budget, and it was part of the last election, it was a response to the housing shortage. doesn't really help. It doesn't help shortage because it doesn't actually bring more houses to the market. But the intent again is to help and to encourage or to help Canadians who don't yet own a home to get into a home by these incentives, this benefit of not paying tax on the money that grows in the account, and also the deductions that are there. So we'll touch on that. But why I'm really going into this is because I want to bring another thing to light. So one of the other tax shelters that's also there, the tax-free savings account. This one came about in 2009. It's been around for over 10 years now. But in the beginning, a lot of individuals made some mistakes in how they use this account. The rules are much more basic than what the rules will be for the first home savings account, because it's a very general sort of tax vehicle. There's no specific intent. It's not specific for retirement. It's not specific for children education. It's not specific for a home. It is broad. There are also not, large rules in terms of a period of time that you have to own, have the money in the account. So it's much simpler, in my opinion, to navigate. It's, if I use the game analogy, it's an easier game to actually wrap your head around, right? If we're gonna say tax-free savings is like checkers, and the FHSA is a little bit more advanced. And I have these things on the screen to just show that even today, even until 2022, there were individuals that had found themselves on the wrong side of CRA because they overcontributed, or they didn't use the account in the way that it was intended. So the concept, and that's what you see on the bottom of the slide, I say, try to focus not on the letter of the law or the rules, but on the spirit of the law. So what does that mean? It means focus on the intent of this account and not necessarily the word by word uses. And what I mean is, a lot of these things have not yet been tested. There's going to be some gray areas. For example, who is considered, am I considered a first time, home buyer? And if somebody starts saying, well, technically I wasn't really living in a home that I own as my principal residence, because yes, I owned a home, but I was actually living with my parents for the last couple of years. So technically, I think I might still be able to use this account. Those are things I'm really saying, hey, be really cautious on that, because the many of these things haven't yet been tested. So focus on the spirit and the intent. Let me get into the eligibility. Some of the main eligibility rules are: one, person needs to be a Canadian resident. They need to be the age of majority. So that says age of majority. It doesn't give an actual number, so that might vary by province. We're in Ontario, that's 18, but it might vary by province. And a first-time home buyer. That might be defined in different ways. So what I have here is one on the right-hand side is a screenshot from actually the CRA website, Canada Revenue Agency. They're the source. And when you really look at the detail, it sort of says that a first-time home buyer, in quotations, for the purpose of opening one of these accounts is different than a first-time home buyer for the purpose of making a withdrawal. So again, nuances to it. And it's not that they are trying to set traps up for individuals. They're trying to not have these accounts being abused. Maybe they want to say, well, we want to help Canadians get their first home, but we don't necessarily want it to be abused by somebody who wants to buy 5, 6, 7 rental properties, right? And that's where, again, you don't want to be caught on the wrong side by incorrectly using these accounts. So that's one of the things I wanted to kind of highlight, the specifics of who is eligible to open this account. The tax-free savings, very basic. Anyone over 18 was able to open an account, and also all you needed was a pulse in order to accumulate contribution room. So what I mean by that is you could have not opened the account since its inception in 2009, and you decide to open one today. Your room kept accumulating, and you can then do a lump sum to catch up with everybody else for all intents and purposes. This is a little bit different. You only accumulate room starting when the account has been opened. So you have to make that effort to open the account. That allows you to then start getting the room to be able to make these contributions. So that's also part of the differences. Something else that is unique with this account is that it has a specific lifespan. So it's a 15-year lifespan, meaning that for the CRA, after 15 years after you've opened this account, you need to wind this thing down, close the account, and either you're buying a house with the funds that is inside this account, or you are moving the money out of this account, closing it, and you can put it into your RSP, without any tax impact. So, I have that sort of, statement down there, which kind of CRA is going to reach out in 15 years and say, so, what are we doing here? Are we buying a house or not, right? So that's something also different from many of the other sort of vehicles. There's no time lifespan for a tax-free savings account, okay? And contributions. So some of the specifics, contributions, you are allowed $8,000 per year up to a maximum of $40,000 for the entire lifetime of the account. And the accounts can't be joint, it can only be single, so only in the name of one person. And also, again, part of the qualifying piece is not just if you were a homeowner, but if your spouse and their status. If your spouse had a home, lived in that home as a principal residence, then that could disqualify you from actually being able to open one of these accounts and use that. So those are really important things to be aware of in that. Now, the specifics on who is policing this. When the account's being opened, the institution is there to sort of guide, but the responsibility will be on the individual. The institution, for all intents and purposes, is going to, one, probably ask questions to clarify and to try to help that person understand. But, if I think about now in 2023, a lot of institutions also allow people to open accounts online. So maybe there's going to be a questionnaire. So there's going to be a lot of more in the honor system for you to, one, be truthful, and also not to, by mistake, make a mistake in getting these accounts open. I've taken this is a screenshot from Canada Revenue Agency, the source. My encouragement to everyone, if you are going to explore this, is to, one, inform yourself of the details of it. There will be lots of information out in the general public from all the institutions out there. RBC, all of the institutions will provide information, provide some sort of summary as they interpret it and as they get it from Canada Revenue Agency. So I would certainly encourage that while you're looking at that, does not hurt to also go straight to the source. The reading might be not as fancy, a little bit more dry, but hey, get it from the source. I think that an informed individual, an informed client is a good client. So that will be one of the things I want to point out today. And the other thing that I wanted to also just highlight is some of the key differences, right, between, that's part of where people are going to say, well, which one should I be using? If I want to put some money and I do want to buy a home, technically I can put it towards a tax-free savings. Yes, you could put it towards an RSP and then still pull that money out for your first home, or you could put it to the FHSA. One of the things I think is special about this account is the fact that if you notice, there's two check marks down below. It gets a check for tax-deductible contributions. So when you put that money into the account, you're able to deduct that against your income in the same way you would when you put money into an RSP. So that reduces your taxable income. So that's good. Everybody, we like that. The other thing that it gets a check mark for, and it's the only one of these three that gets a check for both of them, is that the withdrawals come out tax-free. The withdrawals when you're withdrawing to make that purchase for a home, that is tax-free. So it gets both of those, which is good. The other thing that's also pretty interesting about it, which is different from the RSP, both of them get the check mark for the contributions being deductible. However, you don't have to deduct it, right away, and that's good. You can sort of make the contribution, but still defer that deduction to a future year. And the RSP does allow that. I find a lot of people still just end up deducting it that same year. And if you can imagine, because there is that 15-year time period, imagine somebody at 18, just in university, opening one of these accounts, making a contribution, which maybe is a gift from parents. That's another thing we'll talk about. They may not be in a tax bracket that warrants a deduction. So why not hold off and make the deduction a future year when they're growing in their career, and it's a lot more efficient to make that deduction. But they can still start contributing towards this account. So few things that, as we compare these, and we sort of like that. That brings me to the final slide before we jump into questions, which is, again, still early days, but we're trying to look at how to approach these things strategically. So from a high level, my high level general thoughts is, without knowing specifics or just, big picture, because everybody's situation is going to be different, I would sort of see value in, if you can only do one, then maybe prioritizing the first home savings account. Because it does give you a bit of flexibility, right? Whether you do buy a home or not. So if you do qualify, meaning that you don't currently own a home, principal residence, your spouse doesn't as well, and you would like to purchase one, and you open this account, well, you get the deductions. And if for whatever reason you choose not to, or you don't purchase a home, you can still move that money to an RSP, and you don't need RSP room in order to do that. When it goes into the RSP rules apply. When that money is coming out, it's taxable. So those are some of my high level sort of highlights and things that I think are good about it. And it's something that could be part of a family conversation in terms of, one, transfer of wealth from, one generation to the next. Well, we'll help you purchase that home. Here's, rather than just give you cash, let's use this vehicle as well. So with that being said, I'm going to open it up for questions, and let me just get to see which. Give me one quick second. Okay. All right. So there is a raise hand feature that you can choose. I'm just going to highlight that right now, just so everybody can see where you find that. So some people, I know if you might be on your mobile device. Just look for that little image here, which is a little palm, and then that will allow me to see your hands being raised, and then I can unmute you. All right, so I'm going to pull this down, and we've got one question.
Yeah, I think with market sentiment and mortgage lending standards, I mean, that's kind of a little bit out of our control. Like we can have our own opinions on the market sentiment side of things, but then what the general population does with it, we'll see it in the data. And with the mortgage lending, the same thing. Like, with the stress test right now being 2% higher than the rate, it's like people are getting stressed at 7.5%. So even if you put the money in this account as a first-time home buyer, still you might not be able to get qualified for what you're looking to buy, and that's going to then decrease the demand. But the reason why I talk about the three pillars is because those are the things at least we can look at, and we have the numbers in front of us, and it can give us, like, at least in my opinion, like the best indication of where a market might go. But it's a great question, and the market sentiment could change on a weekly basis, right, based on what's going on. And we've seen that, because even where the market's at now, with things slowly picking up in the first 3 months of this year compared to where we were, I did not anticipate that we were going to be at this point this quickly. I thought the market was going to take another 6 months of kind of just dragging along slowly, and it's come back way faster than we thought. Yeah, I guess just we wouldn't have the data for it, where the other three, at least we can look at the numbers.
At index number.
Well, I'll maybe jump in on that. I mean, the reality is we've got 5 major banks in this country, and we're all regulated by the government quite heavily. And the government has basically created a sandbox for us all to play within. And they really are the ones that dictate how mortgage lenders lend money to home buyers. So to your point, LaShawn, we've got total debt service ratios that we have to follow. We've got stress test rates that we have to follow. We have a few internal programs all lenders and all banks do to make things a little bit easier. For example, we have a specific lending program for newcomers to Canada. We've got a specific program for investors. We've got a specific program for retirees that are asset rich. So all of these programs have different dynamics within them to help people get qualified. Again, all within reason to keep, government and compliance happy. I think the other thing, around the immigration piece is that if you take a look at the government's immigration policies, it really encourages people from around the world to come to Canada that want to buy a home. And so you have that component on top of domestically, Canadians want to buy property, whether it's a home for themselves and their family. And again, the poll showed that investment properties are also top of mind. Cottages, I'm surprised, didn't even move the needle at all, which is shocking because over the last 2 years, we probably financed more cottages than I had in the prior 10, 15. But I think overall, there's a sense that buying a home is a safe way to use your money. We all need to live somewhere anyways. And comparably across the globe, we have a very stable banking sector, real estate sector, and financial sector. So I think, it's not just one thing that sets this all off. It's a combination of a number of things that really, support and allow people to feel confident to buy homes in this country.
Right. Jesse, I think it's because I didn't put, maybe if I put, a vacation property on an island, probably that would have moved the needle.
There you go, maybe. Yeah.
But I'm going to add one thing as well. Add a few things. Your very good questions, very good points. And one of the things that I think the sentiment does get impacted by some of the policies and the decisions that government brings to the forefront. So the first home savings account is one. Prior to that, when they're trying to cool the market, that's where the stress test came in. And that did have its impact, and that may have been, Tom, I don't know if that 2017, when there was that dip, if that may have been around that same time. I could be wrong, but I think there was something around that time. The other thing that I think when I look at one, it's a very small sample, it's just a few people that are on this call, but seeing that a lot of people may have indicated, investment property, I'm going to make a general assumption. Most people on this call are in Toronto, GTA, Ontario predominantly. That's where I'm based. That's where I'm based. Could it be because of the prices? And that's kind of one of the things I'd actually, and is the opportunity of people seeing, well, New Brunswick. I'm not going to necessarily move to New Brunswick to live or buy a cottage in New Brunswick, but the price is attractive. Maybe I'll continue to rent in Toronto because I work here, but if I'm going to buy a property, numbers-wise, is that motivating people to look at other provinces? And that might be some of the conversations that, again, you're seeing with some of your clients, Jesse. Are you seeing, and again, anecdotal, right? Anecdotal, is it that some of these people that are buying in other provinces, it's second, third, and fourth property, or are some people even buying their first property and it's not out in the province that they live, so they're not investing where they live or living where they invest? Anecdotal, but again, when I try to put the different data points together, I wouldn't be shocked, I would say, if there might be a small segment that might consider and say, well, let me look at a bigger picture, and based on where things are at, I'm not necessarily going to want to carry a large mortgage myself, because keep in mind, one of the other stats out there is that a lot of households are now single households. There's more and more single households out there. So could a single person sort of say, all right, I do want to, purchase something for whatever reason, but let me do it where strategically. Just some stuff that, again, just top of mind, that I wanted to kind of, based on the what everybody said. And I'm looking to see, but thank you, though. That was a really, really, really good question, LaShawn. And I think, let me just scroll to see if there's anyone. I want to give fair time to others. Okay. Okay, so I think we've got.
Hey, Orlando.
Yeah,
I've got a quick question. So
sure.
a lot of people said that they're also interested in buying an investment property, but I'm not sure if there's anyone in the call that would be like a first-time home buyer, but buying an investment property because they're under rent control and they don't actually want to move in.
Mm,
So if you buy a property in Toronto, you get the land transfer tax credit back, but you have to move into that property within 9 months. If you're opening this account, even though you're a first-time home buyer, but with the purpose of buying not to move in, can you still do that or no?
yeah, that is an important. Here's the thing. Yeah, I'm glad you brought it up because it's something that was back in my mind to mention. On the CRA website, there is nothing that mentions what if you then rent this property after any period of time. It doesn't say that, well, you will be disqualified if you've rented it below 12 months or 2 years. It doesn't touch on it at all. I don't know what to take from that. But
I've had
you probably had some questions, eh? Yeah.
I've had a couple clients who were younger, first-time home buyers, living at home, saving money, withdraw from an RSP under the home buyers plan to buy an investment property. And, they were told by their accountant that was okay. And, I spent time, same thing, scouring the CRA website. They don't define whether it has to be owner or non-owner occupied. So
far it's the same thing with that. It hasn't been there. It's by the letter of the law, it doesn't say you're going to get slapped on the wrist. I've never heard of anybody, in any recent time with a home buyer's plan being impacted or CRA saying, wait a minute, the way the TFSA has been scrutinized more. So, and that's going to, again, being very open and transparent with everyone, we are also understanding and getting information from CRA as they sort of want, shed more light on it. I've got one other question from Zakia, and then I think you might be last. Zakia, welcome.
Well, so just to confirm, the individual's at home or the individual's primary residence is being rented, but they already own the investment property. So this is where I would definitely say, before I answer this, check with your accountant. However, once an individual's name is on title, meaning they own a property, you are not a first-time home buyer anymore. Okay, so if this property was purchased 5 years ago, the individual moved into it, it was their primary residence, they moved out and rented it, but still own it, meaning they're still on title, you're not a first-time home buyer anymore. Where things change is if that investment property is sold, and then again, this is from the CRA website and a lot of the FHSA documentation. If you have not been on title to a home in the prior 4 years that you're withdrawing or setting up these accounts, you are considered a first-time home buyer again. But again, if today you own an investment property and you're on title to that, but you rent your home and you want to buy yourself a home, you're not a first-time home buyer because you already own a home, right? So again, check with an accountant for your, individual's, circumstances. But again, as soon as you buy a property, whether you live in it or rent it, your first-time home buyer status is no longer really valid because you are entitled to a home. Yeah, so what you can do, what happens is when you approach your RSP provider to process the first-time home buyer withdrawal, there's 8 questions. You have to fill out a questionnaire. Typically, your advisor does that on your behalf and asks the questions. And one of those questions is, have you been on title to a property anywhere in Canada in the last 4 or 5 years? And if you answer yes, you do not qualify for that first-time home buyer withdrawal. You can actually Google the form. It's on the CRA website. So Google FTHB CRA withdrawal form or whatever. It'll pop up as a PDF. And if you run through those questions on your own, it will tell you whether or not you qualify. And that's probably your best guide to determine if you qualify for that withdrawal. Again, always include, your accountant because they're going to know specifics.
Yeah. And it kind of goes back to what I'd mentioned earlier. I think the spirit of it would be not for somebody who already owned a home, however they used it, right? I think it's more, whether that home was a cottage or investment property. Where they're trying to help is that first home purchase. So, you know, when you get into the weeds and technicality, it will be very gray area that I think none of us can really answer properly. That, okay, what if that home that was my rental is actually in a totally different province because I moved from Ontario to Alberta, and I now can't even live in that as my principal residence, and I would like a principal residence in Alberta. You know, again, I'm trying to encourage people, be cautious. Don't necessarily be the one that will be the case study.
Mm-hmm.
Right? So let's not anybody on this call be the case study that now we're like, okay, that doesn't work. Don't do that. here's a court case, right? Because as you've seen, right, even with the tax-free savings accounts, right, there's court cases still happening where people are saying, yeah.
Also, I think it's important, this FHSA was literally just released this month. It's a brand new account, and as soon as the specifics came out from the CRA, people like Orlando, Tom, and myself, and a lot of people, you know, at the bank and investment side came up with a number of scenarios that created questions. And so quite often when the government comes out with things like this, all the different scenarios that could potentially come up haven't been thought about yet. And so it's going to be a work in progress. We'll probably get updates, clarifications from the government over time. And so that's why it's important to, you know, keep in touch with us, and we'll keep you updated along the way.
Yeah. All right. And that's the thing. We definitely wanted to, you know, do we wait until we get all the info and then come to share that? We knew we had a good chunk. We wanted to share that. We know the appetite's there. And then we will continue to get more because there are questions being asked to the CRA with scenarios because, again, you know, a lot of government workers that may not be on the field, seeing all the different things, you know, divorce, separation, what if this happens? Well, you know, and then as we get more information, you know, we try to dissect it. So with that, I'm going to close it off and thank everybody for joining. Hopefully you'll be able to join the next webinar that is coming up for the month of May and June. In May, we're going to touch on more sort of how to invest with impact beyond financial returns. So looking at ESG, environmental, social, governance factors. And in June, I've got Vanguard. Somebody presented from Vanguard. We're going to look at Vanguard's known for ETFs, exchange traded funds, and they're going to talk about their history of ETFs and Investor Alpha, and then a few others that will come the other months in the year. Again, my call to action is always to, you know, continue to learn, be curious, you know, join these webinars. Feel free to reach out if you want to have a one-on-one strategy call. And I'll be happy to, share my knowledge as well as the knowledge for the people that I sort of, you know, surround myself with. And again, you know, my goal from this webinar is to educate, empower people so that they can execute with, you know, with informed decisions. And there's a process that, you know, I go through in terms of really seeing where you're at on your chessboard, and then trying to see if I can help you find a different way to get to checkmate faster. So it's my pleasure to do this. And with that, bid you all a wonderful Wednesday evening and stay safe. Take care. Thank you, Tom. Thank you, Jesse. It's been wonderful.
Take care.
Thanks, everybody. Good night.
Okay.
Good night.
All right.